Yes. Friends, time is 8 o'clock. Shall we start off right now? Can you all hear me clearly and see me clearly? Please type a yes in the chat box, friends, so that I can be sure and we can start off right away now with the flash marathon. Excellent. So I'm audible to everyone. Fantastic, friends. Good evening, everyone. Very, very happy to see you all over here. Welcome to the Flash Marathon. Point number one, you have just come back from an examination hall. You must be exhausted. Your mind must be emotionally drained out. This Flash Marathon is planned mainly for two objectives. Objective number one, after the exam gets over and you reach back home, you are exhausted and it will be very, very difficult for all of you to sit and study on your own. Reason number one. Reason number two, today in the next coming 3 or 4 hours, how much ever time it takes, I have chosen 16 very good questions, which actually covers almost all the areas of the chapter of your syllabus. Only a few areas will not be covered, which you can do tomorrow and day after tomorrow. So with limited questions, you actually end up getting maximum exposure to your subject. All right. So are you all ready, friends, for the flash marathon? Shall we start off with today's session now? Type a yes in the chat box. Fantastic, friends. Let's start off. So point number one, even before I start, your audit paper might have gone good, might have not gone good. Please do not carry forward the hangover of the audit paper to your FM paper. So just be relaxed, give in your best. That's all that we can do now. Don't strain yourself too much. Give in your best, leave the rest. Do what is in your control. Let's not go and try doing things that are beyond our control. All right, friends. So now today I'll start off. I've shown my material over here. So you can see that I have put an arrow mark in certain questions. So why I have done this is because many of the students who are attending this session are my regular students. So or my students who attended my crash classes. For them, already this material is available. So I am going to streamline this material even further down so that in minimum questions, we can cover maximum coverage. That is the objective of highlighting in this material itself. So we are going to work out question number one right now. And question number one is on what approach? Modigliani-Miller approach. Friends, do you remember the formula for Modigliani-Miller? What is the formula? The formula is NP0 is equal to P1 into N plus M plus E minus I whole divided by 1 plus KE. Or NP0 would mean what? It is the market value today is equal to P1 into N plus M would mean whatever is the market value tomorrow. Tomorrow means after 1 year. Plus what are your earnings minus whatever is your investment whole divided by 1 plus KE. Friends, this market value tomorrow plus earnings minus investment is nothing but your cash flows. Market value is your cash, earnings is your cash, investment is an outflow. So this is your cash flow and this is 1 divided by 1 plus KE. When we do it is to take the present value. So can I say in other words, the logic is market value today is nothing but it is the present value of the future cash flow. This is one of the rules that I teach in all my classes, friends. Value of any asset is nothing but present value of future cash flows. Now, friends, tomorrow or day after tomorrow, whenever you have your FM examination, make sure you start with working note number one, basic data. Okay, a very, very important point to start with basic data because whatever be the question, you have to understand the question. You can check with your final students who have attended my class. This exam, many of them could write really well. CA final AFM paper. They could write really well only because of one tool, that is basic data. Basic data might look very easy to all of you, but examination hall, this tool works very, very powerfully. So do not ignore. Please make sure all the questions you start with working note number one, basic data. Point number 8. Rambo Limited has 1 lakh equity shares. So what is the first number that you see over here? 1 lakh. So I'll write down number of shares. 1 lakh equity shares. Okay. The current market price is how much? 100. So I'll write down P0 is equal to 100 rupees per share. Friends, parallelly write down along with me. Okay. Then, because it's a flash marathon, I'll be going a little fast, but I would want to make sure that all of you understand also thoroughly whatever we are taking over here. All right. So market price per share is how much? 100 rupees. Company is planning to pay a dividend of how much rupees per share? Dividend they are planning to pay around 10 rupee per share. Okay. What is the return that they have told over here? Return is said to be 15. Required return 15%. So this is nothing but this is your KE. Based on Modigliani-Miller, they want you to find out what will happen if dividend is declared or the dividend is not declared. How many new share if the income is 40 lakhs? So I'll write down below this income is equal to 40 lakhs. Then they have told investment is how much? 50 lakhs. Investment is 50 lakhs. And they are asking, that's it. These are the details that are given over here. Working note number 1, basic data. Just 5 seconds. Read through this, write this. I will share these notes in my Telegram page and in the WhatsApp group in which you all would already be there. If you don't have the WhatsApp group, let me know. I will join you to the group. All right. Now, shall we begin, friends? So there are two scenarios. I'll write down the next scenario. Situation number 1. What do you want me to take situation number 1, friends? Dividend declared or not declared? Let me take it as dividend declared. We will go by 3 steps. Step number 1 would be calculate P1. P1 means what? Price next year. In order to find out price next year, the formula would be P0 into 1 plus KE minus G. Abhimanyu, you need the material, is it? Do one thing. Those of you who don't have the material, I'll share my Telegram page link right away now. So you can get the material there now itself. Please join this Telegram page. 1 minute. Okay. t.me/Tarun_Jagdish. I'll just put this in the chat box. Please join this Telegram page. I'm sharing the material over here right away now. Wherever you face any difficulties, message and let me know. Okay. I'm sharing the questions also. I'm sharing the solutions also. Done. I've shared it. Please confirm if you have got it, friends. I'll share it on WhatsApp also. Okay. Just a moment. Let me share it on Telegram first. Give me 1 minute, friends. Done. I've shared it on Telegram. You want me to share it on WhatsApp now, correct? All right. Yes, I'll share it on WhatsApp also. It's done on Telegram. I'm sharing it on WhatsApp right now. Give me 1 minute. Done. I have shared the material in WhatsApp also. All right. Friends, I think some students are unable to join. I think it's reached maximum limit here. So wait, let me just share the YouTube link also with everyone. Sorry for the trouble, friends. Please wait for 2 minutes. Let everyone become comfortable. We will finish our complete session. Only then I will go to sleep. All right, I'll share the YouTube link also in my page. Done. Fine, friends. I believe I have done my part. I believe all of you have got the material also. Can I continue now, friends? All right, let us continue now. I believe it's shared everywhere. Right. So friends, as I have told, we have to go by 3 steps. Step number 1 is what? Calculate P1. P1 means what? What is going to be the price next year? So the formula for calculating P1 is P0 into 1 plus KE minus G. Okay. Or the logic of this formula is that price today. How much is the price today? Everyone tell me. It is 100 rupees. Okay. Sorry, not minus G, minus D. Sorry for that's for wrong formula there. Into what is the investor expectation over here? 15% minus D. How much is the dividend they have told over here? 10 rupee per share. So 100 rupees if I invest. Investor is expecting 15% return. So next year, what will be the price, friends? It will become 115. 115 minus 10 rupees paid out as dividend. The moment you pay dividend, the price actually fall down. So 115 minus 10 when you do, what is the answer that you get over here? Your P1 turns out to be 105. Step number 2, in order to calculate the Modigliani-Miller is calculate M. M means what? What are the new number of shares? Now tell me, friends, why do you raise new number of shares? You raise new number of shares only when you need fund or fund requirement is coming in. So let us check that now. Tell me, friends, in this question, how much is the investment that they are planning? Investment is 40 lakhs. Tell me how much is the dividend that they are planning? 10 rupee per share multiplied by how many shares are there? 1 lakh equity share. So can I say you have 10 lakhs? These two are outflow. Less they are having some earnings. How much is the earnings that are available with them? Earnings is 40. Hold on, did I make a mistake? Investment is 50 and earnings is 40, is it? Okay. So investment will be 50 lakhs. Earnings is going to be 40 lakhs. So 50 plus 10, 60 lakh I have to pay. 40 lakh I will receive. What is going to be my fund shortage over here? 20 lakhs. This 20 lakh, I can either take a loan or I can go for equity share. Am I right? So now, suppose I'm going for an equity share. I will divide it by the P1 or the price at which the shares are issued. That is 105. So can somebody please type and tell me, I did not take my calculator. What is 20 lakh divided by 105, friends? Please put in the chat box. 20 lakh divided by 105. I want somebody to help me with it. You can mute and tell me also. Any one person. Okay. Okay. Anjanadri, can you please help me with these numbers? Okay. You can unmute and speak to me, Anjanadri. All right. 19,048. Yes, thank you. Thank you, Anjanadri. 19,048 shares will have to be issued. So friends, we got the new number of shares. Step number 1 is what? Calculate P1. Step number 2 is what? Calculate M. Now I will go to step number 3. What is step number 3? Solve the equation. How do you solve the equation? Left side is NP0. NP0 is nothing but number of shares. That is 1 lakh into 100. So everyone tell me how much is 1 lakh into 100. Do you get the answer as 100 lakh rupees over there? Okay. What is part number 2? RHS. Let us do the RHS now. This one was the LHS, correct? So here what will I do? P1. How much is my P1? 105 into 1 lakh shares plus 19,048 shares. That is the total number of shares after 1 year. Plus my earnings. How much is my earnings? 40 lakhs. Minus my investment. How much is my investments? 50 lakhs. Whole divided by 1.15. Can you please do this and tell me? Anjanadri, if possible, can you tell me the answer? What do you get over here? You should get the answer as 100 lakhs only. Just check it out. Hence proven that LHS will be equal to RHS. Take a minute, write down this and understand. If you have any doubts, let me know. Friends, I hope you are comfortable with the pace. Let me know if I can speed up or if I can slow down. You can pass your comments in the chat box. Okay. Just want this session to be very, very effective for all of you. I will explain logic and we will do it so that with logic you understand FM. That way it's easy for you to remember. Okay, friends, can I go to the next part now? Right? Okay, I'm going to speed up a little bit more now. If others are comfortable, I'll slowly speed up. If you feel to slow down, let me know. All right. Now, so friends, we did the first one, dividend declared. Now, can I go to the second part now? What is the second part? Everyone tell me. Dividend not declared. So everyone tell me we have to do the same steps that we did earlier. Am I right? What is going to be step number 1? Everyone tell me. Calculate P1. What is the formula for P1? P0 into 1 plus KE minus D. So it will be 100 into 1 plus 15% minus. Now the dividend will become how much? 0. So what is going to be your P1 now? Do you get the P1 as 115? Step number 2 is going to be what? Calculate M. M is new number of shares. So here what I will do, I will take the investment. How much is my investment? 50 lakhs. Plus, am I paying any dividend? No. Minus what is my earnings? 40 lakhs. So what is my fund shortage? 10 lakh divided by 115. Anjanadri, can you please help me with the number here now? How much is 110 lakh divided by 115?
8695.65.
8695, or I'll round it up to 8696. Okay. Then I will go to step number 3, where I will prove to you that LHS is equal to what? RHS. LHS, we already know how much is the LHS that we have got over here. Have you got the answer as 50 lakhs? Correct. What about RHS now? P1, what is P1? 115 into 1 lakh shares plus 8696 plus earnings of 40 lakhs minus investment of 50 lakhs whole divided by 1.15. Friends, you do it and see. Sorry, LHS was 100 lakhs if I'm not wrong. LHS is going to be 100 lakhs. Even when you solve this, your RHS will also be how many lakhs, friends? 100 lakhs. Hence, proven that whether you declare dividend or you don't declare dividend, your value will always be the same. This is what Modigliani-Miller will always do. Write down this, finish it off so we can go to the next question. I'll just give you 10 seconds more. Please write it down. I hope you are all clear and understood the concept of Modigliani-Miller. Friends, exam point of view, Modigliani-Miller comes very frequently, and whenever it has come, this is the same type of problem that has come. So what we are covering here is very important, crucial concept from an examination perspective. Right. Shall I go to the next question now? Okay. I will share these notes at the end of the session in the Telegram page and in the WhatsApp group. All right. So please stay active over there. Now I will go to the next. I'll go to the next question. Modigliani-Miller is done. Okay. I will do the question number 3 now. That is a 2-stage dividend discount model. Even before that, let us do question number 4. Okay. Please take question number 4. It is a basic question on Gordon's model and Walter's model. Even before we do, what are we supposed to start with? Working note number 1, basic data. All right. Now here I'll write down point number A. Earnings. What is the earnings that is available over here? Everyone tell me. Earnings is 30 rupees per share. Fine. Point number B, you have dividend. What is the dividend they have given over here? It is 9 rupees per share is the dividend. All right. What is the cost of capital, or KE is given as how much percentage? 15%. IRR or R, the rate of return. R, I'll just put it as R. Rate of return is how much? 20%. They want you to find out the price using Gordon's model and the price using Walter's model. So I'll write down working note number 2, Gordon's model. Everyone tell me, what is the formula for Gordon's model? P0 is equal to D1 divided by KE minus G. So in order to get D1, what is the formula? D0 into 1 plus G. So what is D0? Everyone tell me. 9. into 1 plus growth I need to find out. How do you find out growth? Growth is nothing but retention ratio into ROE. Have they given the retention ratio or the rate of return? Rate of return is given. Retention ratio is not given, but from this data, I can find out my payout ratio. So I will first write down what is my payout ratio. How much is my payout ratio? DPS by EPS. So 9 divided by 30. Can somebody please help me with this number? How much is 9 divided by 30, friends?
30%.
It is turning out to be 30%, correct? So if payout ratio is 30%, how much will be your retention ratio? Can you tell me? It will turn out to be 70%. So if retention ratio is 70%, over here the formula would be 70% into 20%. If I'm not wrong, you get the answer as how much over here then? You get the answer as 14% will be your growth rate. So I'll write down 9 into 1 plus 14%. Can somebody please help me with how much is 9 into 1 plus 14%?
10.26.
You get the answer as 10.26. That is your D1. What is the formula we are using now? P0 is equal to D1 divided by KE. How much is KE? 15% minus G. Growth is how much? 14%. So if I do like this, what is the answer we will get over here? We will get the answer as 1026 rupees per share. Come on, friends, quickly write it down. All right, friends. Are you all done writing this? Now, friends, here I have assumed the dividend per share is D0. So I have to give a note for that. Very, very important. It is assumed that 9 rupee per share is D0. Exam, you will always have a challenge that some may say that this is D1. But friends, normally when they give the data, 9 rupee is given along with earnings. So normally earnings comes from the audited financial statements. Even your dividend will come from an audited financial statement. So that way this will be taken as what? D0. But if the assumption changes, if we take it as D1, your answer will change. Your answer will become 9 divided by 15% minus 4 plus 14%, and your answer will become how much in that case? It will become 900. So you can just give a note. Alternatively, if 9 rupees per share is D1, then value is equal to 9 rupees divided by 15% minus 14%. You will get the answer as 900 rupees per share. Can you please write down this one note in your books now? 900 rupees per share. Fine, friends. So I think you're clear with what is Gordon's model right now. After Gordon's model, what is the next model that we are going to learn now? Next working note will be Walter's model. What is the formula as per Walter's model? D divided by KE plus E into D into R by KE whole divided by KE. So here how much is the D that we are going to take? 9 divided by how much is KE? 15% plus E minus D, that is 30 minus 9 is how much? 21 into R is how much? 20% divided by 15% whole divided by 15%. Can somebody please help me with the calculator and tell me how much is 9 divided by 15%, friends? How much is 9 by 15%? Please help me out.
So 9 by 15% is 6.
Thank you. It's 60. And what about the other one? How much is 21 into 0.2? That will be 4.2. 4.2 divided by 0.15. Again divided by 0.15 will be how much? 4.2 divided by 0.15. Again divided by 0.15.
186.66.
186.66.
66.
Okay, so if I add up these two things, do I get the answer as 246.67 rupees per share? Am I right? Okay. Okay, friends. So we are done with this part. 10 seconds. Please write this down. Then we go to the next question. All right. Can I go to the next one now? Okay. So we are done with Walter's model question, Gordon's model, Walter's model also. Now we will do a question on two-stage dividend discount model, a very important question. It keeps coming in the examination. Okay. X is a, so as I do, we'll start off with basic data. Question number 3, working note number 1, basic data. Point number A. The current market price of a share is how much? 2185. So I'll write down market price 2185. During the financial year 2020-21, the company paid 140 as dividend. So D0, what the company paid is how much? 140. Okay. Paid D0. Company is expecting a growth of 12% for the next 4 years. Growth is equal to 12% for the next 4 years. All right. And 5%. So then you have a 5% from 5th year to perpetuity. Everybody clear with this part? All right. And the KE is given as how much percentage? 18%. KE is equal to 18%. So friends, we are done writing the basic data. Now let us try analyzing this question. Are you all ready to analyze the problem now? So friends, here what is basically happening is, if I'll draw a diagram to show you. Fine. So here, I'll call it as D0, D1, D2, D3, D4, and then you have D5. Okay. So they have told here the growth is going to be 12%, 12, 12, and 12. And from 5th year onwards, hold on. Let me just see. The growth will be 12% for year 1, year 2, year 3, year 4. Correct. And for 5th year onwards, it's going to stabilize to how much percentage? 5%. Now from here, this will go forever. This will go towards infinity. So friends, please interact and tell me now, how much is the D0 that we have? 140. Someone, can you please take a calculator and interact with me? How much is 140 plus 12%?
156.8.
156.8. Okay, now what is 156.8 plus 12%?
175.61.
6. Okay. What about the next one? Again, this plus 12%.
196.69.
Okay. Plus 12%.
220.29.
Plus 5%.
231.31.
231.31. All right. So these are the D1, D2, D3, D4, and D5. Value of any asset is nothing but present value of future cash flow. So I'll just come down here itself and I'll write down here cash flow, discount factor, discounted cash flow. Year 1, your cash flow is going to be 156.8. Year 2, it is going to be 175.6. Year 3, 196.69. Year 4, 220.29. Year 5 goes towards perpetuity. So what we do is D5 divided by KE minus G. Perpetuity formula is Gordon's formula. D5 divided by KE minus G will give you what? It will give you P4, or price at the end of which year? At the end of the 4th year. Okay. This 4th year price, I will put it over here again and I will take the present value. So P4 will be equal to 231.31 divided by 18% minus, what is the stable growth they have told? 5%. Okay. Can somebody please tell me, if I do it like this, what is my P4? How much will be my P4?
1779.30.
1779.30. So here I'll write down 1779.30. Now, can you please take the present value and tell me what is the present value you get over here? If I'm not wrong, your answer should be 1408. Please confirm. Let everyone do it. I'll slow down a little bit here. One four zero eight. Or friends, the value over here turns out to be how much now? 1408. Okay. I'll just give you a minute more. Some of you must be still writing it. Please do it. This is a tricky part. So this is the important part, friends. Exam, this part will come. So we need to understand how to do this and how to take this value from here and put it over here. So take a minute. If you have any doubts here, let me know. Normally, this question comes in the exam. Ashita, I took the present value at 18%. I took the discounting factor at 18% and I took the present value. You will get 1408. Diya, you want me to repeat P4? I'll repeat once again. See, what is happening is this 231 is going forever. Once it goes forever, the formula that we use is D1 divided by KE minus G. The only difference is here it is not D1. Here it is turning out to be what? It is D5. So when I do D1 divided by KE minus G, I get P0, correct? Just like that, when I do D5 divided by KE minus G, I get the answer as P4. Are you clear now? Okay. So once you get this P4 price at the end of which year? 4th year. That 4th year price, I will take it and bring it over here. And again, I will take a present value to year 0. Diya, are you clear? If you have doubts, you can unmute and speak to me, Diya. Clear, right? Fantastic. Fine, friends. Can I go to the next part now? Right. So we are done with two-stage dividend discount model also. Let's go to the next question. Next question is coming on leverages. Okay. So as I always do, we'll start with what? Working note number 1, basic data. Question number 7. Working note number 1, basic data. Sales is equal to how many lakhs? 86 lakhs. Point number B, PV ratio 35%. 35%. Friends, there is a mistake in the question. They have told fixed cost including interest, but the solution they have solved it using excluding interest. We will do it using excluding interest. Okay, so I'll write down very clearly over here. Fixed cost excluding interest. So how much is the fixed cost excluding interest? Do you get the answer as 10 lakhs over here now? Correct? And 10% debt is 55 lakhs. Okay. Then they have told equity share capital 75 lakhs. $75 lakhs. And then you have income tax rate. What is the income tax rate that you have over here? 40%. Okay. Now, friends, from this, I will write down working note number 2, analysis. What will I do in the analysis? I will find out the hidden information. Everyone tell me, if they are providing you with the sales and they're giving you the PV ratio, from this, what can you find out? Can I find out the contribution? Tell me, friends, how much is 86 lakhs into 35%? I need you to help me with an answer. I haven't brought my calculator. I'm traveling actually. Can somebody please help me? What is 86
30 lakh
lakh?
10,000.
How much?
30 lakh 10,000.
Okay, so you get the answer as 30 lakhs 10,000, correct? Okay, now fixed cost is given excluding interest, but now we can find out the interest amount. How much is 55 lakhs into 10%? Do you get the answer as 5 lakh 50,000? Am I right? Then they have given you the equity capital is given and the tax rate is also given. Fine. So once you get the contribution, once they have given you the interest, here only I will write down the fixed cost also. How much is the fixed cost? 10 lakhs. From this, can I find out my profit before tax? So how much is 30 lakh 10,000 minus 10 lakh will be 20 lakh 10,000, 15 lakh 10,000. I think your answer would be 14 lakh 60,000. Correct me if I'm going wrong there, okay? On this, what will be my tax rate? 40%. How much is 14 lakh 60,000 into 40%?
5 lakh 84,000.
5 lakh 80?
84,000.
5 lakh 84,000. All right. So once you reduce this, can you tell me how much will be your profit after tax?
8 lakh 76,000.
Do you get the answer as 8 lakh 76,000, friends? All right, fine. Okay, so now once you get these numbers, I would like to put this in the contribution or in the profitability statement format, because only then I will be able to find out my financial leverage and my operating leverage. So I'll write down the next working note heading, operating income, or let me just call it as income statement. I will call it as income statement. All right. So what will I do? I'll start with sales. How much is my sales? 86 lakhs. Less what? Variable cost. That will give me contribution. Less what? Fixed cost. This will give me EBIT. Less what? Interest. This will give me EBT. Less what? Tax. This will give me what? Earnings after tax. Everybody clear? So 86 lakhs. This one, if I'm not wrong, is 30 lakh 10,000. So the variable cost will be the difference between these two. That, if I'm not wrong, will be 55 lakh 90,000. Okay. How much is the fixed cost they told over there? 10 lakhs. So this thing would turn out to be 20 lakh 10,000. How much was your interest? 5 lakh 50,000, correct? Okay. Once you reduce this, you get 14 lakh 60,000. Tax amount we found out as how much? 5 lakh 84. And you get the final answer as how much? 8 lakh 76,000. Everybody clear so far? So once you get this answer in your books, from this, I can go and find out my leverages. So I'll write down the next working note heading, leverage. There are three types of leverages, friends, that you have learned. What is the first leverage that you have learned? Operating leverage. How do you find out the operating leverage? Contribution divided by EBIT. What is the second leverage that you have learned, friends? Financial leverage. What is the formula for that? EBIT divided by EBT. What is the third and the final leverage that you are learning over here? Combined leverage. What is the formula for that? Operating leverage into financial leverage, or you have a better formula. What is a better formula? Contribution divided by EBT. Now tell me, how much is the contribution that you have got? 30 lakh 10,000 divided by 20 lakh 10,000. This one would be 20 lakh 10,000 divided by 14 lakh 60,000. And what about the last one? 30 lakh 10,000 divided by 14 lakh 60. Can you please help me with the numbers over here now, friends?
Sir, operating leverage 1.49.
1.49. Okay, what about financial leverage?
1.38.
1.38. Okay, what about combined leverage?
2.06.
2.06. Perfect. Okay, I'll just give you 10 seconds cool off time. Please understand till here, friends. Are you all clear so far? Yes. All right, friends. I believe all of you are clear so far. So we got operating, we got financial, we also got combined leverage. Now let us read the question. We have put the basic data. We have done the analysis. Determine the company's return on capital employed and EPS. Okay, so I'll write down the next working note heading. ROCE. They wanted pre-tax. What is the formula for ROCE, friends? ROCE, pre-tax will be earnings before interest and taxes. We will not consider tax at all over here. That is for both. So divided by what? Equity plus debt. So how much is your EBIT? 20 lakh 10,000 divided by equity plus debt. How much is your equity that you have over here, friends? Given in the question, I think we wrote down somewhere. 75 lakh is the equity, 55 lakh is a debt. So the formula would be 75 lakh plus 55 lakhs. So that will be 20 lakh 10,000 divided by 120, 130 lakhs. Can you tell me what is the answer you get over here in that case?
15.46.
15.46%. Everybody clear? Next thing what they are asking is earnings per share. How do you find out the earnings per share? Total earnings after tax is what we will take. How much is the earnings after tax? 8,76,000. Then what will you take over here? You will take the number of shares. Everyone tell me what is the number of shares? I think it's given in the question somewhere.
7,50,000.
7,50,000, correct? Okay. So now tell me, when you do 8,76,000 divided by this, what is your earnings per share that you get over there?
1.168.
Fantastic. You get the answer as 1.17 rupees per share. Perfect, friends. All right. Are you all clear with this part now? Can I go to the next one? Okay, I'm going to the next part now. So we are done with requirement number 1. Does the company have a favorable financial leverage? Tell me, friends. Does the company have a favorable financial? How much is the financial leverage that we have got? 1.38. What is the logic of 1.38? For every 1 rupee of earnings before tax, I have 1.38 rupees of earnings before interest and taxes. So my EBIT is much better. Hence, I have a favorable financial leverage. Everybody clear, friends? That is one way of looking at it. The other way, so I'll just write down. whether company has favorable financial leverage. One way of looking at it is that since degree of financial leverage is greater than 1, it means earnings is covering interest. Hence, DFL is favorable. This is one way of looking at it. There is another way of looking at it. Or, friends, how much is the ROCE that we got? ROCE is how much? 15%. But interest is only how much percentage, friends? 10%. So if I borrow 1 crore, I have to pay interest of 10 lakh. But by investing this 1 crore, I will get 15.46 lakhs. Am I right? Okay. Hence, financial leverage is favorable. Is favorable. Take a minute, understand this. If you have any doubts, please let me know. All right, friends. Can I go to the next part now? Right. So I think we are done with favorable financial leverage part also. Let's read the next one. Calculate the operating and combined leverage of the company. Already done. If the calculate the percentage change in EBIT, if sales increases by how much? 10%. Friends, how we will do this, I will tell you. Next working note, I will write down analysis of operating leverage. Okay. Now tell me, what is the formula for operating leverage that we have learned? Contribution divided by EBIT. Or we can also find out the same thing using the formula percentage change in contribution divided by percentage change in EBIT. No, sorry. Percentage change in EBIT divided by percentage change in contribution, or percentage change in EBIT divided by percentage change in sales. Why? Because whatever is the percentage change in sales will exactly be the percentage change in contribution also. You will not have any change over there. So friends, if these are the formula, now how much is the degree of operating leverage that we found out earlier? Did we get the operating leverage as 1.49? So here the formula would be 1.49 is equal to, what is the percentage change in sales they are saying? Sales increases by 10%. Change in sales 10%. What will be the percentage change in EBIT? Tell me, friends, using this equation. Therefore, percentage change in EBIT is equal to, if I'm not wrong, do you get the answer as 14.9%, friends? Yes, I'll give you a minute. Write down and understand this part. Fantastic, friends. Okay, so we are done with this requirement also. Can I go to the next requirement now? Are you all ready? Okay, next one. At what level of sales the EBT of the company will be equal to 0? So now, friends, they want EBT to be 0. So I'll write down the next working note heading, analysis of combined leverage. Okay, so here I'll write down, what is the formula for combined leverage? Degree of combined leverage is, I think it is contribution divided by EBT, or percentage change in EBT divided by percentage change in contribution, or percentage change in EBT divided by percentage change in sales. How much is the degree of combined leverage we found out earlier, friends? Did we get the answer as 2.06? So 2.06 is equal to, now what are they saying? At what level of sales? Oh, they're asking at what level of sales the earnings before tax of the company will become 0. Is that what they're asking? Okay, let's check. Will be the percentage change in EBT divided by percentage change in sales. What is the sales that we have right now? How much is the EBT that we have right now? 14,60,000. All right. They want to make the EBT as 0. Is that what the question is asking? Yes. So what is the percentage change in EBT? 14,60,000 has to become 0. Am I right? How do you make it as 0, friends? 14,60,000 divided 100% fall in EBT is what we are looking at, correct? All right. So to get this, I would say 2.06 is equal to 100% divided by percentage change in sales. So therefore, percentage change in sales will be equal to 100 divided by 2.06. Can you tell me how much is 100 divided by 2.06?
48.5.
Do you get the answer as 48.5%? So they are trying to tell that if the sales is going to fall by 48.5%, automatically your EBT will become 0. We can just go and cross-check this, friends. Shall we just check for a proof? Proof. Particulars. Current. Revised. Now tell me, what is the current sales that you have? 86 lakhs, correct? Sales. Then I'll directly write down contribution minus fixed cost will give you EBIT minus interest will give you EBT. So right now, what is the sales that you have with you? If I'm not wrong, it is 86 lakhs. Your contribution is 30 lakh, 10,000. Fixed cost, 10 lakh. EBIT, 20 lakh, 10,000. Interest, 5 lakh, 50,000. So if I reduce this, I get the EBT as how much? 14 lakh, 60,000. Now let us work it out. Now we are going to make the sales fall by how much percentage? 48.5%. Can somebody please tell me how much is 86 lakhs minus 48.5 percentage? 86 lakhs minus 48.5 percentage.
44 lakh 29,000.
44 lakh 59,000. In the
Sir,
question, they would have given
29,000.
50.
29,000.
29,000, is it? Okay. Now tell me in the question, they have given you a PV ratio. How much is the PV ratio? They have told 35%. How much is 35% of 44 lakh 29,000?
15 lakh 50,000 150.
15 lakh
155,015.
50,150. Is it? Okay. Minus 10 lakhs. So what will come over here? 5 lakh 50,000 150. And the interest is 5 lakh 50,000. Your net profit EBT becomes how much? 150 rupees. That is a rounding off error, friends. Ideally, this should become how much? 0. Hence, proven that if the sales is going to fall by 48.5%, your EBT will become 0. I'll give you a minute. Write down this. Understand so far. We are done with this question on financial leverage and operating leverage also. This was a tricky problem. So once you do this, major adjustments of operating leverage, financial leverage are already covered over here. Everyone clear, friends? All right, friends. So we are done with this question also. Shall I go to the next question now? Question number 7 is done. Let us go to question number 14 on ratio analysis. Everybody ready? Friends, around 9:15, 9:30, I'll give you one 5-minute short break. Okay? Fine. Question number 14 now. Working note number 1. Basic data. Now, share capital 10 rupee each, 10 lakhs. So I'll write down equity capital is equal to 10 lakhs. All right. Shares of 10 rupee each. So face value is equal to 10 rupee. Therefore, I can here only tell that my number of shares is going to be how many shares? I will have 1 lakh shares. All right. Reserves and surplus to shareholders fund. So reserves and surplus divided by shareholders fund is nothing but capital and reserves and surplus. That is equal to how much? 0.50. Sales to shareholders fund. So sales again divided by capital plus reserves is again equal to how much? 1.5. EF. Current ratio. You know the formula for current ratio? Current asset divided by current liability. That turns out to be how much? 2.5. Next one. Debtors turnover ratio. So that is sales divided by debtors. Friends, debtors turnover ratio can be done in cost also, can be done in market value also. If it is done on cost, then the formula will change. It will be cost of goods sold divided by debtors. For time being, I'm assuming it to be based on sales. So I think you get the number as how many times? 6 times. Correct? Next thing. Stock velocity. What is the formula for stock velocity? Stock divided by sales into 12 months has given you the answer as 2 months. Stock velocity, then GP ratio is GP divided by sales is equal to how much percentage? 20%. Net working capital ratio, turnover ratio will be this divided by sales. That is current asset minus current liability. Sorry, I put the formula wrong. It is going to be sales divided by net working capital. That is equal to how much, friends? 2.5. I'll give you a minute. Write down this. Understand this thoroughly, because based on this, we will be solving the next question. One by one, we'll be solving it. All right, friends. Shall we start off with the first one now? We'll start off with reserves and surplus to shareholders fund. So I'll write down working note number 2, analysis. In this, I'll write down Roman number 1, reserves and surplus to capital plus reserves and surplus is equal to 0.5. So I will take the reserves and surplus as X. X divided by how much is the capital we have? 10 lakhs plus X is equal to 0.5. X is equal to 0.5 into 10 lakhs plus X. Okay. So X will be equal to 5 lakhs plus 0.50x. Or in other words, 0.50x is equal to 5 lakhs. And therefore, X will be equal to 5 lakh divided by 0.5. Or do I get the reserves as 10 lakhs over here, friends? Therefore, my shareholders' funds will be equal to 10 lakh of equity plus 10 lakh of reserves and surplus. Total will turn out to be how much, friends? It will turn out to be 20 lakhs. Please write down till here in your books now. Your brain must be getting a bit tired here. Relax and write down, understand the concepts here itself. Every question we are covering maximum adjustments. So you will be getting good exposure in limited time. All right, friends. So I think once you're clear and once you have got the logic of shareholders' funds, many other things will fall in place. For example, the next thing is what? Sales divided by shareholders' funds. So I'll write down Roman number 2, sales bar shareholders' funds. So let the sales be X divided by 20 lakh is the shareholders' funds. That is equal to 1.5. Therefore, X over here will turn out to be how much, friends? 30 lakhs. So we have got the sales as how much now? Sales is equal to 30 lakhs. Everybody clear with this part? Next one. Once you get this, next they have told debtors turnover ratio. So I have told you it is sales divided by debtors. So Roman number 3, debtors turnover ratio. So the formula is sales divided by debtors is equal to how much? 6. Or in other words, 30 lakhs divided by X is equal to 6. Therefore, X is equal to 30 lakh divided by 6. Or do you get the answer as 5 lakh rupees over here? You get the answer as 5 lakh rupees. Can I go to the next part now? Roman number 4. After that, they have given you stock velocity. So I'll write down Roman number 4, stock velocity. The formula for stock velocity is stock divided by sales into 12 months is equal to 2 months. So X divided by 30 lakhs into 12 months will be equal to 2 months. Or in other words, X will be equal to 2 divided by 12 into 30. So I think like that you will get the answer of stock as how much? 5 lakhs. So the value of stock will turn out to be how many lakhs? It will turn out to be 5 lakhs. Take a minute time, write down this and understand so far. Friends, 1 minute. They have done stock velocity based on cost of goods sold. Okay. So that one thing is there where we need to be a bit careful. They have done it based on cost of goods sold. They haven't done it based on sales. So one moment, friends, the numbers will change. I'll put it with reading pen. Cost of goods sold. So how much is the cost of goods sold? We need to find out first. All right. How much is the sales or the GP ratio? They have told 20%, correct? So the cost of goods sold ratio will be 80%. So cost of goods sold will be equal to 30 lakhs into 80%. That will be equal to how many lakhs? 24 lakhs, friends. So here I'll put the number as 24 lakhs. So if you put 24 lakhs, your number will change. Can you tell me what will be the number that you get over here? Doing it based on sales is not wrong. Okay, that's also correct. Yeah, what's the answer you get?
4 lakhs.
You get the stock value as 4 lakhs, not 5 lakhs. Exam, if you do using sales, nothing wrong because both the formulas are there in your books. Okay. So I think we got the stock value as 4 lakhs. Okay. We got the debtors value as 5 lakhs. Correct? Right. Can I go to the next one now? Okay. Next one, we will do net working capital ratio. Net working capital ratio. So how much was the net working capital ratio that they have told over here? 2.5 times turnover ratio. So that means sales divided by net working capital is equal to 2.5 times. Or in other words, 30 lakhs divided by net working capital is 2.5. Therefore, net working capital will be 30 lakhs divided by 2.5. Can you tell me how much is 30 lakh divided by 2.5?
12.
12 lakhs.
Do you get the answer as 12 lakhs over here? Perfect. Take a minute, write this down. Perfect. So once we get this, we have been given the current ratio. What is the current ratio? I'll write down the next Roman number 6. Current ratio. Current ratio is equal to current assets divided by current liability. We now know current assets minus current liability is net working capital. That is equal to how many lakhs? 12 lakhs. This is equal to 2.5. Or can I say current assets divided by current liability is equal to 2.5, or in other words, current assets is equal to current liability into what? Current liability into 2.5 times. Am I right? Now, hold on. Here, can I say current liability is nothing but 12 lakhs? Hold on, I'll put it this thing. Okay. Or I can rephrase this as 12 lakhs plus current liability is equal to current assets. Am I right? Friends, I'm just trying out something. Let's see if I work out and I get the answer. This is current asset is equal to current liability into 2.5. Okay. So I'll bring this down. 12 lakh divided by 2.5 plus current liability divided by 2.5 is equal to current liability. Now tell me what is 12 lakh divided by 2.5? 12 lakh divided by 2.5. Can somebody please help me? What is 12 lakh divided by 2.5?
4,80,000.
Okay, do you get the answer as 4,80,000? So it will be 4,80,000 plus CL divided by 2.5 is equal to current liability. Am I right? Yes. Wait. I've messed up somewhere. Give me 1 minute, friends, to rectify this. Let me just take it together and see. So 12 lakh plus current liability whole divided by 2.5 is equal to. Okay, wait, friends. Wait. Give me a minute. I've made some mess up here. This 2.5 current liability. Okay, I don't think I need to do so much of complications here. Wait. I think I have simply complicated things. Sorry, friends. Give me 1 moment. Okay. What I can do is I can say that. 1 minute. Okay, I can instead say current asset is equal to 2.5 into current liability. That's an easier way of doing it. Yes. So now what I can do, I can say 2.5 current liability minus current liability is equal to 12 lakhs. So 1.5 current liability is equal to 12 lakhs. Therefore, current liability is equal to 12 lakhs divided by 1.5. Can you tell me what is 12 lakh divided by 1.5?
8 lakhs.
You get the answer as 8 lakhs. Yes, this is easier. So sorry, friends, I simply complicated things. So once you get this as 8 lakhs, I can say current assets minus current liability is the net working capital. That is turning out to be how much? That is turning out to be 12 lakhs. So current assets minus 8 lakhs is equal to 12 lakhs. Therefore, current assets will be equal to how many lakhs, friends? It will turn out to be 20 lakhs. Oof. Take some time, write this down. Sorry, friends, I just mixed up the formula and it became a bit confusing. Yes. Yes, friends. Are you all done with this? Okay. So once you get this, Now I'll put the next working note, analysis of current assets. Now in this point number A will be what? Total current assets. Everyone tell me how much is the total current assets? 20 lakhs. From this, how much is debtors that we found out? 5 lakh. How much is the stock value that we found out? 4 lakh. So the balancing figure will be cash. So how much is going to be the cash that they are going to have over here? They will have the cash of 11 lakhs. Okay. Now let us just go and check it again. They're asking for shareholders funds. We got stock. We have got debtors. We have got current liability. We have got cash balance. Also, we have got. So we are done with this question also. Are you all clear with this problem, friends? I'll give you a minute. Just read through this. If you have any doubts, please let me know. All right. Yes, friends. Are you all clear so far? So friends, we have done revising dividend policy chapter where we did Modigliani-Miller, we did Gordon's model, we did Walter's model, we did two-state dividend discount model, financial leverage is covered. Now, ratio analysis is also covered over here. Fantastic. Can I go to the next question now? After one question, we'll take a 5-minute break. Is that okay? Now we will do a question on cost of capital. Okay. Working note number 1, basic data. Question number 17. Working note number 1, basic data. Jason Limited is planning to raise additional finance of how many lakhs? 20 lakhs for meeting its new project plan. So, additional finance, 20 lakhs. Okay. It has 4,20,000 in the form of retained earnings. Already, how much is their retained earnings, friends? 4,20,000. Okay. What is the debt equity ratio? 30:2. Debt equity means debt is to equity. That is turning out to be 30:70. Cost of debt up to 3,60,000. So it is 8% up to 3,60,000. And beyond that is how much? 12% beyond 3,60,000. All right. EPS is how much rupees per share? EPS is equal to 4 rupees per share. 4 rupees per share. Dividend payout. Dividend payout is equal to 50% of earnings. How much is the earnings? Have they given the earnings per share somewhere? Okay, we'll just keep that pending. It is 50% of earnings. Okay. Then they have told MPS is 44. MPS is 44 rupees per share. Growth is 10%. Fine. And the tax rate is given as how much percentage? 40%. Okay. So they have what? This is a question on cost of capital. I'll give you a minute's time. Write down the basic data. Understand the question thoroughly. Friends, earnings is given over here as 4 rupees. So 50% of earnings will be 50% of 4. How much is 50% of 4? Can you all tell me? It turns out to be 2 rupees. Fine, friends. Are you all done writing this? Now, friends, how much is the total additional finance they need? 20 lakhs. This can be raised either by way of equity or this can be raised by way of debt. Okay. They have told the ratio, debt equity ratio is 30:70. So debt is going to be 30%. Equity is going to be 70%. How much is 20 lakh into 70%? 14 lakhs will be equity and 6 lakhs will be debt. Out of this 14 lakhs, I want to break it up into two parts. One is new fund. Other one is retained earnings. I think question already has told that some money is already kept there as retained earnings. What is the amount kept as retained earnings? 4 lakh 20,000. Correct? So what will be the new fund required by this thing? It will be 9.8 lakhs. Everybody clear? And in this 3 lakh 60, 6 lakhs of loan that is required, up to 3 lakh 60, what is going to be the interest rate that they have told over here? 8%. Beyond 3 lakh 60, how much extra will be required? 2 lakh 40. This is beyond 3 lakh 60. Here, what is the percentage that you are getting over here, friends? Here you get the answer as 12%. Okay. So friends, please put this chart in your books. I'll give you a minute's time. Okay. Now tell me, can somebody please help me out? What is going to be 3,60,000 into 8%? How much is 3,60,000 into 8%?
28,800.
Is it 28,800? Okay. And how much is going to be 2,40,000 into 12%? 24,000 and 4,800, is it?
28,800.
Do you get the answer as 28,800 over here? So when you add up these two things, total will be how much? 56. I think you will get the number as 57,600. Correct? This is the total money that you are going to get on a loan of how much? 6 lakhs. All right. So from this now, I need to find out what is my cost of equity and I need to find out what is my cost of debt. So I'll write down, I'll go to the next page and I'll write down next to working note cost of equity. P0 is equal to D1 divided by KE minus G. We know the P0 over here. How much is the P0? 44 rupees is equal to D1. How much will be D1? 2 rupee plus growth. Growth is 10% divided by some KE minus 10%. Friends, so I'll do a reworking now. So indirectly, KE minus 10% will be equal to 2.2 divided by 44, or KE will be equal to 2.2 divided by 44 plus 10%. So 2.2 by 44 will be 5%. I think your answer will turn out to be 15%. Fantastic, friends. Fantastic. Please do this now. 15%. That will be your KE. Now we are going to find out what, friends. We will go and work out your KD now. So I'll write down the next working note. KD. Now tell me what will be, how do you find out KD? KD will be whatever is the interest into 1 minus tax divided by P0. So in our case, how much is the interest amount we found out over here? Is it 57,600? 57,600 is pre-tax into 1 minus 40%. I believe 40% is the tax rate. Am I right? Whole divided by what is the total loan that they are taking? 6 lakhs. So can you tell me what is 57,600 divided by 6 lakhs into 1 minus 40% divided by 6 lakhs?
5.76%.
Do you get the answer as 5.76 percentage, friends? All right. So once you get 5.76 percentage, after this, I can go and find out my WACC, WACC. That is KE into weight of equity plus KD into weight of debt. So my KE is 15 percentage into weight of equity is, if I'm not wrong, 0.7 plus KD is how much? What is the KD that you have? 5.76 percentage into 0.3. So can you tell me, if you do like this, what is the overall WACC that you get over here? Your answer will be, please help me out, friends.
12.23.
12.23 percentage. So we are done with the question on WACC also. I'll give you a minute. Do it and finish it off. Friends, I hope you're all comfortable so far. All right. Shall we now take a 5 minutes of cool off time? Yes. After the cool off time, let's just see what are the other questions that we need to work out. Next, we have one more question on cost of capital. We are doing this one. Okay, this is a very good question. You are having all adjustments coming in. All right. So a very good problem. Then that will be followed by capital structure. We are having 2 questions. Working capital will be doing 2 or 3 questions after that. All right. So let's take a 5 minutes of cool off time, after which we'll resume with the second session. Thank you so much. We'll resume at 9:30. What's the time now? 9:22. We'll resume at 9:30, friends. Okay, 9:30. Thank you. Friends, I'm back. Shall we resume now? Okay, somebody has asked me the cost of retained earnings. Anjanadri, normally the cost of equity and cost of retained earnings are the same until there is some different data that is available in the question. All right. Yes. Can I go to the next question now? Question number 21. Working note number 1, basic data. MR is having the following capital structure, which is considered to be optimum as on 31/3/2022. So you have equity share capital that is 8 lakhs. 8 lakhs in bracket, they have given 50,000 shares. So can you tell me 50,000 shares into, if I'm not wrong, it will be 14, correct? No. 10 would be 5 lakhs, 11, 5 lakh, 50, 12, 13, 14, 15, 16. Am I right? It will be 16 rupees per share is how you will be getting 8 lakhs, correct? Then they have told you 12% preference shares, 50,000. Okay. Then what have they told you? The next 15% debentures. 15% debentures will turn out to be how much? It will be 1,50,000. So friends, what is the total funds of all these things? 8, 9 lakh 50. Do you get the answer as 10 lakhs? Or in other words, this is turning out to be 80%. Preference share is going to be 5% and debentures are going to be how much? 15%. Please put up till here. All right, I'm going to the next part now. So we're done with the first part. The EPS of the company was 2.5 in 2021. So I'll write down working note number 2, analysis. There I will write down point number A, EPS in 2021. That is equal to how much? 2.5 rupees per share. All right. Then expected growth in equity is 10% per year. Growth is turning out to be 10%. The next year's dividend will be 50% of EPS of 2021. So D1 is going to be 50% of 2.5. That is equal to 1.25 rupees per share. All right. Next one. Current market price is 25. So the MPS is turning out to be 25 rupees per share. All right. Now, 15% new debenture can be issued by the company. Okay. So 15% new debenture can be issued at a price of 96 rupees per share. New 12% preference shares. New 12% preference shares is sold at a net price of 91.5 rupees per share. Okay. And the tax rate is face value is 100. Tax rate is how much percentage? Is equal to 30%. Friends, once you write down the basic data like this, you thoroughly understand the question. And once you understand the questions, answers ideally come automatically. Please write down till here in your books and understand so far. All right. So friends, from all this data, we need to find out what is your KE. We need to find out your KP and we need to find out your KD. So I will write down the next working note heading KE. Working note number 3, KE. P0 is equal to D1 divided by KE minus G. Or in other words, KE is equal to D1 by P0 divided by G. Plus G, sorry. D1 is how much? 1.25. Divided by P0 is how much? Price 0. Have they given the market price somewhere in the question? No? Yes, the current market price is 25. Did I forget to write down that in the page? It's written over here. Divided by 25 plus, I think they have directly told that the growth is going to be 10%. Am I right? So what is 1.25 divided by this? That's 5. So if I'm not wrong, you will get the KE as how much percentage over here, friends? 15%. Then I'll write down the next working note, KP. So KP will be nothing but it will be the preference dividend divided by the current market price. So now tell me how much is the preference dividend that you have? 12%, that is 12 rupees on 100 rupee face value divided by 91.5. Can you tell me what is 12 divided by 91.5? Someone, please tell me.
0.131.
0.131, or do you get the answer as 13.11%? Then I'll go to KD. KD, how will you find out? Interest into 1 minus tax divided by whatever is the market price. So what is the interest rate? They have told 15% debenture. That will be 15 rupees into 1 minus 30% divided by 96. So can you tell me what is the answer you get over here? Do you get the answer as 10.94% over here, friends? Fantastic. So we got KB, KE and KP. From this, can I now go and find out my WACC? What is the formula? KE into weight of equity. Write down the formula mandatorily in the exam, okay? KP into weight of preference. KD into weight of debt. So how much is KE that you told me? KE is 15%. 15% into 0.8 plus KP was how much? 13.11% into 0.05 plus, what about the last one? 10.94 into 0.15. Now tell me, when you do like this, what is the answer that you get over here? Overall WACC, how much do you get?
14.3.
Do you get the answer as 14.30%, friends? So we have got the weighted average cost of capital. Let everyone finish. All right. So I think once you are clear with WACC or once you're clear with WACC, we can read the next part of the question. They're asking you to calculate the after-tax cost of new debt, new preference share, new equity share, and marginal cost of capital. Friends, correct? We will call this as marginal cost of capital. Why? Because these are all new. Marginal COC. Because it is new KE, new KP, and new KD. Everybody clear? Then they are asking you how much can be spent for capital investment before sale of new equity share, assuming that retained earnings for the next year investment is 50% of 2021. So how much can be spent for capital investment is what they are asking. Hold on. How much can be spent for capital investment before issuing new shares is what they are asking. So friends, some amount should be invested. Out of that, 80% has to be equity. 5% has to be preference. And the remaining 15% has to be what? Debt. Now they are saying retained earnings is going to be 50% of what? 50% of earnings of 2021. How much is the earnings of 2021? 2.5. That is one share. How many shares are there? 50,000 shares are there. So what is 50,000 into 2.5? So here the formula would be 50,000 share into 2.5 of that 50%. Of that 50% will be the retained earnings. How much is that turning out to be? Can you tell me? I think you will get the answer as 60 to 500. Okay. So extra equity is 60 to 500. That should be how much percentage? That should be 80%. So tell me what is 60 to 500 divided by 80%? JP, I'll just come back.
78,127.
Yeah. Yes, come again.
78,125.
So 78,125 will be a total fund that you can bring in, out of which retained earnings will be 62,500. Preference will be 5% of 78,125. How much is 5% of 78,125? Can somebody please tell me?
3906.
3906. And how much is 15% of 78,125?
11719.
1171?
9.
So this is the new fund that can be raised. New fund that can be raised. Okay. So JP, you had a doubt. JP, can you please unmute and speak to me? What language are you comfortable in, JP? Can we interact in Malayalam if that's what you're comfortable in? JP, please unmute and tell me. Yeah.
Clear ആണെന്ന് എനിക്കറിയില്ല.
ഇപ്പൊ ക്ലിയർ ആണ്. ഇപ്പൊ കേൾക്കുന്നുണ്ട്. ഓക്കെ ശരി. ഓക്കെ.
ഇതിൽ പറയുന്നുണ്ടല്ലോ ഇക്വിറ്റി ഷെയർസ് അസ്യൂമിംഗ് ദ ന്യൂ ഇക്വിറ്റി ഷെയർസ് കം ഫ്രം റീറ്റെയിൻഡ് ഏർണിങ്സ് എന്ന്.
അതെ.
അപ്പൊ എന്താ ശരിക്കും അതുകൊണ്ട് മീൻ?
അതിന്റെ അർത്ഥം എന്താന്ന് വെച്ചാൽ ഓൾറെഡി എത്ര ഇക്വിറ്റി ഉണ്ട് ക്വസ്റ്റ്യനിൽ എത്ര തന്നിരിക്കുന്നേ?
നമുക്ക്
8 lakhs തന്നിട്ടില്ലേ? 8 lakhs അല്ലേ തന്നിരിക്കുന്നേ? ശരിയല്ലേ? അപ്പൊ 8 ലക്ഷം ഓൾറെഡി ഇക്വിറ്റി ഉണ്ട്. ഓക്കെ. ഇത് കൂടാതെ കുറെ ലാഭം കിട്ടി. ആ ലാഭത്തിൽ നിന്ന് ചിലപ്പോൾ അവർ എന്ത് ചെയ്യും? ഡിവിഡൻസ് കൊടുക്കും. ശരിയല്ലേ? അത് കൊടുത്തു കഴിഞ്ഞിട്ട് ഒരു 62,500 കൂടി അവരുടെ ഇക്വിറ്റിയിലോട്ട് ആഡ് ആയിട്ടുണ്ട്. നേരത്തെയുള്ള ഇക്വിറ്റി 8 lakhs ആണെങ്കിൽ now your equity will be 8 lakh plus 62,500. Okay. അപ്പൊ അങ്ങനെ വരുമ്പോൾ എന്ത് സംഭവിച്ചു? ഇക്വിറ്റി became 8,62,500. I am supposed to maintain a ratio of 80:5:15. Am I right?
Okay.
So if this becomes 8,62,500, automatically preference should also increase, debt should also increase. Otherwise, the debt equity ratio will change. Correct?
Okay.
അപ്പൊ അത് ശരിയാക്കാനാണ് ഈ 62,500 80% ആണെങ്കിൽ ടോട്ടൽ എക്സ്ട്രാ ഫണ്ട് എത്ര കൊണ്ടുവരണം? 78,125 കൊണ്ടുവരണം. അപ്പൊ അങ്ങനെയാണെങ്കിൽ പ്രിഫറൻസ് ഇത്രയായിരിക്കണം, ഡെപ്റ്റ് ഇത്രയായിരിക്കണം. ക്ലിയർ ആണോ? Clear അല്ലേ? ഓക്കെ. പിന്നെ സെക്കൻഡ് വൺ, തോമസ്, യുവർ ഡൗട്ട് ഇസ് വാട്ട് ഇസ് ദ ഡിഫറൻസ് ബിറ്റ്വീൻ MC മാർജിനൽ കോസ്റ്റ് ഓഫ് ക്യാപിറ്റൽ ആൻഡ് WACC? തോമസ്, weighted average cost of capital considers the entire capital, entire debt, entire preference share. Whereas marginal cost of capital only considers the new equity, new debt, new preference share. Are you clear now? Here, the assumption is that the new equity, new debt, and new preference share are also in the ratio of 80:5:15.
Okay, sir.
മനസ്സിലായല്ലോ? Okay? Okay, fantastic. Everybody clear? Can I go to the next part? Okay. So we are done with this question also. Question 21 is over. So new debentures and preference share to be issued to meet the capital ratio. Exactly, Ansil. To meet the capital ratio, we will do this. Okay. Next question. Okay. Next question is a question on capital structure. Shall we do it together now? Question number 23. Working note number 1, basic data. So there they have given you EBIT is 3 lakhs. EBIT 3 lakhs. Interest on debt. How much is the interest on debt? 50,000. You normally get one adjustment question like this for sure in the exam. EBT 2 lakh 50. 2 lakh 50. Income tax at the rate of 50% is turning out to be 1 lakh 25,000. So your profit after tax or your earnings after tax will be 1 lakh 25,000. Okay. Then you have new number of equity shares, 25,000. So your EPS is turning out to be how much rupees per share? 5 rupees per share. They have given you the PE ratio that is equal to 10 times. Market price, what will be your market price over here? It will become 50 rupees per share. Company has reserves and surplus of 7 lakh 50 and required 5 lakh further for modernization. So already company, okay, wait, one more thing. First you write down till here. Then we will go to a fresh page. YouTube students, I believe you are all comfortable. All right, friends. I believe you are all done writing this now. Fine. Now, friends, here they have told company has reserves and surplus of 7 lakh 50. I will write down working note number 2, analysis. Friends, here, first thing I can find out my equity capital. So they have told my equity capital is 25,000 shares into 10 rupees. So can I say that turns out to be 2,50,000? Reserves, they have told how much is there in the question, 7 lakh 50. So what will be my total shareholders funds? That will turn out to be how much? It will turn out to be 10 lakhs. Okay. So once you have the total, this thing as 10 lakhs, they require 5 lakh further. So fund for modernization. Fund required for modernization is how much? 5 lakhs. All right. ROCE is constant. ROCE is constant. So they're going to keep it constant. Debt equity ratio higher than 40% will bring the PE ratio down to 8. So debt equity ratio greater than 40% will reduce PE ratio to how much? 8. And interest will increase to how much? Interest will increase to 12% on additional debts. So extra loan, whatever you take, you have to pay extra 12%. So they're asking you if what will happen if you bring the additional capital by way of debt or you bring the additional capital by way of equity. So we are having two options over here. Everybody clear? Even before we go to any of the options, I will first write down in the next working note ROCE. How do you find out the ROCE? I will take the EBIT first. How much is my EBIT? 3 lakhs. Then I'll write down what is my equity plus what is my existing debt. My equity was 10 lakhs. What is my existing debt? Interest on debt is 50,000. That is 10%. So can I say my debt value is going to be 5 lakh, 50,000 divided by 10%? So here it will be 10 lakh equity plus 5 lakh. Total will be 15 lakhs. Okay. Therefore, what will be your ROCE? A divided by B. So tell me what is 3 lakh divided by 15 lakhs? 20%. So what the question says is that 20% of ROCE will remain the same. Are you clear now? All right. Now what we will do, I'll write down the next working note. If additional funds by way of equity, we can bring the extra money by way of equity also. We can bring it by way of debt also. Am I right? Now tell me, how much is going to be my EBIT? It won't change. It will be the same. How much is my EBIT? 3 lakhs. Okay. Minus interest. How much will be my interest now? Same 50,000 because extra fund I'm raising. Okay, wait. EBIT will change. Sorry. My new EBIT will be, what is my ROCE? 20%. Extra, how much money I'm bringing in? 5 lakhs. So right now my funding is 15 lakhs plus 5 lakh more will come. On the entire thing, I will get 20% ROCE. So 20 lakh into 20% will be how much? 4 lakhs. But my interest is going to be how much? Same, 50,000. So I will get my EBT as how much? 3 lakh 50. Tax is 50%. That will be 1,75,000. So my EAT will be 1,75,000. Now my number of equity shares will change. As of now, how many shares I am having? 25,000 shares. Extra, how much fund I am raising? 5 lakh at the prevailing market price. And if I am not wrong, the prevailing market price was 50 rupees, correct? 5 lakh by 50 will be this, and this will get cancelled. Then you have 50,000 by 5. This will become 1. That will be another 10,000. So you will have how many shares now? 35,000 shares. So can you tell me what will be your EPS in this case? How much is 1,75,000 divided by 35,000?
5, sir.
5.
Is it 5 rupees per share? No. Something wrong. It's not 5. 1,75,000 divided by this cannot be 5. Is it 5? 35,000 into 2 is 70,000. Okay, correct. Sorry, friends. I think my brain was doing some wrong calculation. You'll get 5 rupees per share. Once you get this as 5 rupees per share, what will be your market price? 5 rupee per share into what is the PE ratio that they are having? 10 times. So do you get the answer as 50 rupees per share over here? Okay, everybody clear with this part? So that is if you raise it by way of equity. Now I'll write down the next working note. If additional funds are by way of debt. Additional funds are by way of debt. Now, friends, if they are coming by way of debt, first I will take my EBIT. Now my EBIT will be how much? 4 lakhs. Less my interest now will be, earlier I already have an interest of 50,000 plus. Now I am taking extra 5 lakhs. The moment I take extra 5 lakhs, my debt equity ratio goes up. On that extra 5 lakh, my interest will turn out to be a higher rate. What is the higher rate told in the question? 12%. 60,000. So that will be 1,10,000. So once this comes in, what will be my EBT? 2,90,000. All this, what will come now? Tax. How much tax will come? 1,45,000. What will be your EAT now? 1,45,000. So your EPS now will be 1,45,000 divided by only 25,000 shares. New shares are not being issued. So what is 1,45,000 divided by 25,000 shares?
5.8.
5.8. Therefore, now your MPS, here the PE ratio will be only how many times? It will come down to 8 times. Do you get the answer as 46.4? So which is better, friends? Here you get 46.4. But in the previous case, you get a market price of 50 rupees per share. So tell me which one is better? Equity is better or debt is better? Equity is better. Read and write down this. I'll give you a 1 minute cool off time. Then we go to the next part. I hope you are clear with this part now, friends. All right, friends. I believe you're all done with this part. Perfect. So we are done with this question 23 also. Shall we go to the next one now? Okay, friends, next one is also question number 25. This is again actually similar to what we did now. Here you have debt in different forms. Let's quickly do this. I'll do it a little fast because it's similar to the previous question. Okay. Question number 25. Working note number 1. Basic data. All right. Here they have given you the output of how many units? Output is equal to 1 lakh units. Selling price is equal to 40. Variable cost is 20. Therefore, your contribution is how much? 20. Your total contribution will become how much now? 20 lakhs. Less fixed cost will be how much? 10 lakhs. Therefore, your EBIT will be how much over here? It will be 10 lakhs. Okay. Have they told anything about interest over here? Nothing. Equity capital, reserves, the current liabilities. That's all. Tax rate, have they told somewhere? Okay, we'll I think read the tax part is given as 40%. We'll work out that separately. As of now, we get an EBIT of how many lakhs? 10 lakhs. Okay. I will now write down working note number 2. Analysis. Okay. So down equity reserves 15 lakhs, current liability 5 lakh, total 20 lakh. Raj has decided to undertake an expansion project to which will involve 20 lakhs. So I'll write down point number A. Additional investment. How much is the additional investment you need? 20 lakhs. Company expects an increase in the output by how much percentage? 50%. So revised output will be 1,50,000. If it's going up by 50%, it will be 1,50,000. Okay. Fixed cost will be increased by 5 lakhs. So revised fixed cost will become 15 lakhs. All right. What else have they told over here? Variable cost per unit will be decreased by 15%. So 20 minus 15%, if I'm not wrong, will be how many rupees? 17 rupees per unit. If it is 17 rupees, what will be your revised contribution? 40 minus 17 will be 23 rupees per unit. All right. Next part. The additional output can be sold at the existing selling price without any adverse impact on the market. So selling price can be the same. Now they are having 3 options. One, 5 lakh debt, balance 15 lakh can come as equity. 10 lakh debt, 5 lakh as 10 lakh as equity. 14 lakh as debt, 6 lakhs as equity. Current market price is 200 rupees per share. Fine. Slab wise interest rate up to 5 lakh you have to pay 10%. 5 to 10 you have to pay 15%. Over 10 you have to pay 20%. So which is the best option is what they are asking over here. Everybody clear? So friends, this is a very easy problem. I'll just take the next working note. Analysis of the 3 options. I'll draw a table, particulars, situation 1, situation 2, and what is the last one? Situation number 3. All right. So first one is 5 lakh, 15. Second one is 10 lakh, 10 lakh. Last one is 14 lakh, 6 lakhs. All right. So now what I will do is I will write down. First, I will write down my contribution. How much is going to be my revised contribution? 23 into 1,50,000 units. Can you tell me what is 23 into 1,50,000 units?
34,50,000.
Is it 24,50,000?
34 lakhs.
34, is it? Okay. Minus fixed cost. How much is the fixed cost? 15 lakhs. So once I reduce this, what will be my EBIT? I think it is going to be 19,50,000. That will be the case in every scenario. After this, only things will change. Minus what will be the next thing that I'll get over here? Interest. So as of now, do I have any interest? As of now, I don't know whether I have interest or no. But now at 5 lakhs, situation 1 is 5 lakhs. On 5 lakhs, the interest rate is going to be how much percentage? 10%. That will be 50,000. Okay. Here for 10 lakh, the interest rate will be 50,000 plus on the next 5 lakh, the interest rate is going to be 15%. So 5 lakh into 15% will be 75,000. Third case, it will be 50,000, 75,000. And the final slab again, you'll have 4 lakhs. On that 4 lakhs, 20%, that will be 80,000. After this, I will get what? I will get my earnings before tax. That is 19 lakhs, 18 lakh 25,000. I think it is 17 lakh 45,000. Am I right? From this, I'll reduce the tax. What is the tax rate told in the question?
40%.
Is it 30 or 40? 40%. How much is 19 lakh into 40%? Can you tell me?
7,60,000.
What about the second one? It's 7 lakh 30. 6 lakhs 98. So you will get the answer as 11 lakh 40,000. 10 lakh 95,000. 10 lakh 47,000. Okay. Now, what will I do? I'll put the number of shares. So now what will happen in the first case? 15 lakh of fund I'm raising by way of new shares. Already how many shares are there in the question? Already 1 lakh share is there. So the formula would be 1 lakh share plus for this 15 lakh, they have given the market price. What is the market price? 200. I think that will give you how many number of shares? 75,000 shares. So here the number of shares will be 1,75,000. Here it will be 1 lakh plus 10 lakh divided by 200. And here it will be 1 lakh plus 6 lakhs divided by 200. So what is the number you will get over here? Wait, I think I made a mistake. This should be 7,500. So 1 lakh 7,500. 1 lakh 5,000. 1 lakh 3,000. So once I do this, I will get the final answer. EPS will be 10.6, 10.43, 10.17, which is the best option out of these. I'll give you a minute's time. Write down this and understand this part. Yes, friends, are you all done with this? Fantastic. So we are done with question number 25 also. I'm going to the next question now, friends. Okay. Friends, next question, question number 26 is a question on tandem committee lending norms. From your textbook, this has been removed. Okay. But I have seen many a times that ICI will ask questions from the past examination. So it will take max to max 5 minutes of our time, friends. Let's not ignore this. Let's just learn it and keep it. By chance it comes, we will be ready. That's the reason I brought this question into the material. All right. So here, tandem committee norms basically is a norms that is used for the purpose of issuing loan. Okay. So what I'll do is I'll just take my solution and we'll discuss it from the solution itself. I think it's already available here. Yes. What is the question number we are talking about? 26, right? All right. Friends, in question number 26, as per tandem committee norms, there are basically three criteria. Method 1, we take the 75% of current assets minus current liability. So current assets is basically nothing but you take up all these things, raw material, work in progress, finished goods, debtors and cash. All that together is 480 lakhs. Current liability is how much? It is turning out to be 280 lakhs. That is nothing but how do you get this 280 lakhs? That is 100, 180. This is how you get 280 lakhs. Are you all clear? Okay. So once you get this, first formula is what? 75% of current assets minus current liability. So like this, when you do, you get the answer as 150 lakhs. Option 2 is 75% of current assets minus total current liability. That way you get the answer as 80 lakhs. Here you got 150, here you got 80. Method 3, they get the answer as 75% of current assets minus core current assets, whole minus current liability. So that is 75% of 450 minus 280, you get 57.5. Friends, normally when they get three answers, they take the least of the three. So method 1 gives you 150, method 2 is 80, and method 3 is 57.5, which is the least of these 57.5. Hence, that will be your minimum, or that's the maximum permissible banking finance. Just read through this now, friends. So we are done with this question also. Just read through this and we'll go to the next one. All right, friends. Can I go to the next question now? Okay. Let me go to the next question now. 26 is done. Let us do 27, working capital management, a tricky chapter. Many students find it a little tricky, so I will go a little slow over here. Okay. And this is the final topic that I'll be covering for all of you. All right. So I will write down question number 27. Working note number 1, basic data. Until core current assets is directly given in the question itself. See, 30 lakhs is directly given. You're asking in real life, what is core current assets, is it? Let's check that, even I'm not familiar. Core current assets, banking meaning. Let's just search that. Hardcore working capital It's a key investment vehicle, blah, blah, blah. I think we'll research this after the exam. Now it's a very tight situation. Let's just understand in exam, they'll give you what is core current assets. Okay, right. So friends, next one. A regular customer of your company has approached you for extension of credit. So here you have to understand what's happening. Okay. This fellow is your regular customer. Okay. This is you. Okay. He's saying, I want to extend my credit. Friends, what will happen when you extend the credit? Your fund gets blocked. Once your fund gets blocked, automatically what will happen? You will end up paying more interest by way of opportunity cost. I will show you how. Okay. So now they have done a past performance. Based on the past performance, within 30 days, how much payment do they make? 20% of the bill they will make. Okay. At the end of 60 days, how much will they make? 30. Then again 30. Then again 18% is what they make. And non-recovery will be how much, friends? Non-recovery will be 2%. So in other words, customer was, that is a past trend that they are following over here. Okay. So friends, I'll do one thing. I'll just write down working note number 2. Okay. I think 30 days into 20%. Fine. Let's keep it that way itself. Customer wants to enter into a firm commitment for purchase of goods of rupees 40 lakhs. So expected revenue. If the customer is purchasing, what are we doing? We are selling. Am I right? So expected revenue is how much? 40 lakhs. Now, deliveries to be made in equal quantities on the first day of each calendar year. So quarter 1, quarter 2, quarter 3, quarter 4. Price per commodity is how much? 400. So the selling price is equal to 400. Okay. Then what is the profit they have told? 20 rupees. Therefore, what will be the cost involved over here? 380 rupees, correct? What is the total number of units that you have? If total revenue is 40 lakh divided by 400 rupees, what is the answer you get over there? Can you tell me? Is it 4,000, 40,000, 4 lakh, 40 lakh?
10,000.
Zeros. Is it 10,000 units? Am I right? Okay. So the total turns out to be 10,000 units. Okay. So this is the analysis of cost. Then they have told it is also anticipated that taking up this contract would mean you will have an extra recurring expense of how much? 20,000. So I'll write down extra recurring expense will be 20,000 rupees. Opportunity cost is how much percentage? 18%. And they have told 1 year is equal to how many days? 1 year is equal to 360 days. Please read through this and understand this part thoroughly. Unless you understand this, solving the problem will become very, very difficult for all of you friends. All right. So now what I will do is from this, I will prepare a profitability statement. I will write down the next one. Profitability statement, where I'll write down the first thing will be sales. How much is the sales that you have? Is it turning out to be 40 lakhs? Then you have variable cost. Tell me friends, how much is going to be your variable cost? 380 rupees into what? 10,000 units. So do I get the answer as 38 lakhs? Then we have extra recurring expense. How much is that? 20,000, correct? So once I reduce these, what will I get? I will get my GP, or I'll get my gross profit, that is 1 lakh 80,000. Am I right? Once I get this, from this I have to reduce my bad debts because they have told 2% of the people will never pay. If you read the question, 2% of the bill they will never pay. 40 lakh into 2% is how much? 80,000. Okay. So once you reduce this, what will be your profit that you get over here? Do you get it as 1 lakh? Now here I will write less opportunity cost. Now that is what I need to work out. So once I find out this, I will get my final profit. Okay. Can you please put up till here in your books now? So if my opportunity cost is more than 1 lakh, there is no use of giving credit period because my fund is getting blocked and I'm paying a very, very high interest. All right, friends. I believe you're all done with this part. Okay. Now, I'll go to the next page and I'll write down the next part is what? Opportunity cost. So friends, first I need to see because of 40 lakh of sales, 38 lakh 20,000 is my fund getting blocked because my fund gets blocked in expense. So you can take 40 lakhs also over here, nothing wrong. You can either take 40 lakh or you can take 38 lakh 20. Of this 38 lakh 20, 20% of the money you will get within, how much is 20% of 38 lakh 20,000? Can someone tell me?
Seven lakh 64,000.
Okay, do you get the answer as 7,64,000? Okay, this is going to be blocked for how many days is what they told in the question? 30 days. Am I right? Okay, so I'll write amount, credit period, fund blocked. So tell me how much is 7,64,000 is blocked for 30 days. So what is 7,64,000 into 30 divided by 360?
11,460.
7?
11,460.
11,460 is it? That is going to be my fund block for the first one. Now tell me what is the second one they have told? 30%. How much is 30% of the bill amount? How much is 38 lakh 20 into 30%? I think it is 11 lakh 42,000. Please cross check. This is going to be blocked for how many days now? 60 days. So what is 11 lakh 42,000 into 60 divided by 360? Tell me, friends, what is the answer you will get over there? Can somebody please help me? What is 11 lakh 42,000 into 60 divided by 360?
1,93,333.
1 lakh
90,333.
330. This is the fund block in the second scenario. Third scenario, how much percentage have they told over here? Again, 30%, but 90 days. So this will be 11 lakh 42,000, but here it is going to be 90 days. So can you tell me what is 11 lakh 42,000 into 90 divided by 360?
2,85,500.
2,85,500.
500.
500 is it? Okay. What is the next thing they have told? 18% within 100 days. 18%. How much is 38 lakh 20,000 into 18%?
6,87,600.
87,600 and the final 2% is anyways gone. So no use of working out on that. Okay. This is going to be blocked for how many days now? This will be blocked for 100 days. So what is 6,87,600 into 100 days?
One lakh 91,000.
Okay. So if I add up all these things, can I find out what is going to be my total fund blocked? Add up all these numbers.
Sir, the first one has to be 63,666.
Oh, there's a difference, is it? Okay, 63, 666. Okay. Thank you, Ashwin. All right. So add up all these numbers and tell me what's the total fund blocked.
Seven lakh 30,496.
On this, I have to pay an interest of how much percentage? 18%. So what is this into 18%? Can you tell me?
1,31,489.
490 rupees. This is going to be your fund blocked. So once I get this answer, I'll go back and write down over here 1,31,490. I am actually making a loss of 31,490. So tell me, should I give so much credit period? Yes or no? Credit period should not be given. Friends, I'll give you a 1 minute cool off time. Write down this in your books. Understand this. Any doubt you have, ask me. 30% amount is 11 lakh 46. Correct. 11 lakh 46, is it? Not 11 lakh 42. Please double check and tell me, friends, and the numbers will change. Is it 11 lakh 46? If that is the case, what is going to be your fund blocked?
For 60 days, 1,91,000.
Okay. And for 90 days? Into 90 by 360.
Two lakh 86,500.
2,86,500. Bad debts is on sale value. 18%, I by mistake deleted the number, friends. Can you tell me once again what is 687,600 into 100 divided by 360?
One lakh 91,000.
Do you get the answer as 1,91,000? Okay, so now tell me what is the total fund blocked? One lakh 31,790. You're telling the final answer is 1,31,790, is it? Okay. Just tell me
Total
this.
fund block is 7,32,166.
All right. So here I'll just go and put the same number again. 1,31,790. I'll put over here. 1,31,790. So minus 31,790. I think now we are through. Okay, take some more time. Write down this. Understand this diagram. This is the major thing. Fund block is where working capital works on. Whether there's stock or debtors, your fund gets blocked. Write down if you have any other doubts. Let me know. This was a heavy problem, friends. Working capital is generally a tricky chapter. Okay, are you all clear? Yes. Now just go through this also. Fine, friends. I think you're all done. So we are done with this one heavy problem on working capital management also. Now let us go to the next question, which is a question on factoring. Friends, factoring has got some advantages, savings in bad debts, savings in administration cost, but it has got some drawback also. Let us work out the factoring problem now. So as we always do, all questions will start with what? Working note number 1, basic data. The factoring firm has got an average collection period is 80 days. Average collection period 80 days. 0.5% of the debtors default. So 0.5% of sales is your bad debts. All right. And it will also suffer the losses of bad debts together. Factor has agreed to pay over the money due to the company after 60 days. So factor will pay within how many days? 60 days. So how many days do you get relief? 20 days relief is what you get over here. Am I right? Okay, let me go to the next part. Then they have told factoring commission is 20%. Factoring commission is equal to 20%. The company spends 1 lakh per annum on administration of debtor. Admin cost is 1 lakh. Okay. And annual credit sales is 90 lakhs. Variable cost is 80% of sales. The variable cost will be, if I'm not wrong, 72 lakhs, correct? 80% mean be 72 lakhs, correct? Borrowing cost is 15%. Interest is 15%. 1 year is equal to 365 days. All right, friends, I'll give you 1 minute time. Read through the basic data. Understand this thoroughly. Then we will dig out the hidden information one by one. All right, friends. Shall we now try doing it together? Okay. So, friends, while write down working note number 2, analysis. Let us read working note number 1 and find out the hidden information. First one, they have told bad debts is 0.5% of sales. So, from this, I can find out the bad debts amount. Bad debts amount will be 90 lakhs into 0.5%. So, do you get the answer as 45,000 rupees? Okay. Next one. Factor will pay within how many days? 60 days. Okay, that we'll do it separately. Let us find out the factoring commission now. How much is the factoring commission? 20% of 90 lakhs. How much is 20% of 90 lakhs? Friends, I think there is a mistake. It is actually 2%, not 20%. Sorry, there's a mistake. How much is 2% of 90 lakhs? Everyone tell me.
1,80,000.
80,000. That's a question typing error. Okay, sorry for that. Then what is the next thing we see in the basic data? Admin cost is given. Variable cost we found out here itself. Okay, fine. So now I need to find out the opportunity gain over here. Okay. So I'll write down fund blocked currently. So friends, as of now, my cost is 72 lakhs. Of this 72 lakhs, 80 days fund is getting blocked. Am I right? What is 72 lakh into 80 divided by 365? Come on, please tell me.
15,78,082.
15,78,000.
82. 082.
This is a fund block currently. Okay. Then I'll write down fund block after we appoint the factor. So after factor comes into picture, 72 lakh into only 60 days fund will be blocked, correct? So what is 72 lakh into 60 by 365?
11,83,561.
So friends, how much is my fund that is getting released over here? 15 lakh minus 11 lakh. I think 4 lakh, 3 lakh something, right?
3,94,521.
521. If this much of my fund is getting released, how much is my interest that is getting saved over here? 3,94,521 into what is the interest rate they told in the question?
15%.
15%. So how much is 3,94,521 into 15%?
59,178.
59,178. This is the logical way, friends. If you check your solution, they have done it in a very dangerous style. You won't understand how they got the answer. Look over here. 90 into 0.8 into 0.15 into 80 minus 60 divided by 365. They got the answer as 59,178. But this is the real logic as to how this number is coming. Okay. I think once you get this 59,178, I can now do cost benefit analysis. Okay. So I'll write down the next working note. Cost benefit analysis. Okay. Roman number 1, benefits. What are the benefits? You have savings in bad debts. Then you have what? Savings in administration cost. So tell me how much is the savings in bad debts that you get over here? 45,000. What about the savings in administration cost? I think around 1 lakh, right? Total will be 1,45,000. What about the cost involved over here? Point number A. Factoring commission. How much is the commission that we found out now? 59, 148 or 178? 178. What is the other expense that you have over here other than factoring commission? Can you tell me? Bad debts. Sorry. I think it's only this, correct? Factoring. Sorry, this is the, I think I used the wrong word here. This is also my benefit. It's not my cost. Sorry. 59,178 is my cost. Savings in interest. So what is the total you will get over here now? 2,04,178. Against this, your cost is going to be only one cost. What is that? Factoring commission. So how much is your factoring commission that we worked out? 1,80,000. What is your net benefit over here? That will be, I think, 24,178. So tell me, friend, should we accept the factor? Yes or no? Factor should be Accepted. We are done with this question also, my dear friends. Write down, finish it off. I'll give you a 1 minute cool off time. You all must be exhausted now. We have done too many problems so far. We have covered a lot of conceptual areas in minimum time. Hopefully, 2 or 3 questions should come directly from this. Liana, that will mix up the things that I had planned for. It's already done earlier. It's there in the recorded session. You can take it from there if possible. And students have almost reached their saturation point now. We have few more questions. I think 2 or 3 left. All right, friends. Are you all done writing this? Okay. So we are done with annual savings, or we are done with the factoring question also. Let me go to the next one now. Okay, next one is a question on cash budget. Friends, cash budget, we'll do it in the end. It will be a lengthy procedure to do a cash budget, but actually it is a very easy thing to do. So we'll discuss this and finish it off. Let us do the other problem. Friends, I'm not doing questions on EOQ. You know the formula for EOQ, right? Square root of 2AB divided by C, or you would have learned some other alphabet if required. Ultimately, you have to find out EOQ, reorder level, maximum level, etc. All this you have learned in your costing also. And then there is a Baumol model. Baumol model is similar to EOQ. Only thing is that it is done for cash purposes instead of doing for goods. That is the only difference between that. Okay. Then, which is the next question we are working out? Question number 33. I think this and the cash budget are the final 2 problems we need to do. Let us do question number 33 first. Everyone take question number 33. Please read through the question and understand the question. Cash budget we'll read and discuss together. I'll tell you the logic. If we sit and work out, we'll be spending too much of time on that. Okay. So now they are doing an activity level of how many units? 52,000 units. So I'll write down question number 33. Working note number 1, basic data. All right. So I'll write down point number A, activity level. So what is the level they have told over here? From this, I can find out my total raw material cost. How much will be my total raw material cost? 400 into 52,000. Can you tell me how much is 400 into 52,000, friends?
Two crore 8 lakhs.
Is it 2 crore 8 lakhs? Okay. Same way, we need to find out the second one, wages. That will be 150 into 52,000. So what is the answer you get?
78 lakhs.
78 lakhs. All right. What is the next thing that you have? Overheads is 200 per unit. 200 into 52,000. I think that will be 104 lakhs. Correct. Next one is what? Selling and distribution, 100 rupees per unit. ₹52 lakhs. Okay. Last one, selling price. 1,000 units into 52,000. 520 lakhs. Am I right? Okay. So from this, I can actually find out my profit also. Can you please work out and tell me my profit? I think it will turn out to be 80, 60, 80 minus 2, 78 lakhs will be your profit. 1 minute, write down this and understand this part. So we have got the profit over here. Everybody clear so far? Okay. Now I'll write down working note number 2. Analysis. Friends, did you observe one thing? All questions we started with working note 1 basic data. Every question. All questions, same presentation style. That is the best way from an exam point of view. Down they have told raw material and finished goods will remain in stock for how many weeks? 4 weeks. So I'll write down in this Roman number 1, raw material stock will turn out to be, what is the raw material cost that we have got over here? 208 lakhs. So 208 lakhs, it will remain in stock for how many weeks? 4 weeks. So it will be 4 divided by 52. Can you tell me what is 208 lakh into 4 by 52?
16 lakhs.
Do you get the answer as 16 lakhs? This will be your raw material stock. Then they have also told finished goods will also remain in stock for how many weeks? 4 weeks. So finished goods stock. Friends, first thing, when I talk about finished goods, what and all comprise of finished goods? Raw material, 208, correct? Plus, what else will come? Wages also will come in finished goods. Am I right? Everything will come actually. 78 lakhs. Then what will come? Overhead 104 lakhs. Overhead 104 lakhs. Selling overhead 52 lakhs. That's it. I think these are the 4 things. So when you add up all these things, what is your total cost? $278, $286, $386, $390, $390, $442 lakhs. Of this, 4 weeks into 4 by 52. So what is 442 lakh into 4 by 52?
34 lakhs.
Do you get the answer as 34 lakhs? Okay. Now I'll go to the next one, Roman number 3. What is the next thing told over here? Work in progress. So WIT takes 4 weeks. How do you find out work in progress? I will take raw material, which is normally taken as 100% complete. Whereas wages, we normally take it as how much percent complete only? 50% complete. Even overheads, we take it as how much percent complete? 50% complete. So if this is 100% complete, this will be 208 lakhs. How much was the wages that we have? 78 lakhs, correct? But this is only 50% complete. Do I get the answer as 39 lakhs? How much is the overheads that we found out? 104 lakhs, correct? That also 104 lakh into 50%. That will be 52 lakhs. Okay. So now tell me, what is your total work in progress? 208, 238, 247, 247, 297, 299 lakhs if I'm not wrong, correct? Just correct me if I'm going wrong here, okay? Into how many weeks did they tell over here in the question? 4 weeks into 4 divided by 52. Tell me what answer you get over here.
23 lakhs.
23 lakhs. So I think I did it correctly. Okay. 23 lakhs. Perfect. So we got raw material, we got finished goods, we got work in progress. Debtors are allowed 4 weeks. So now I'll write down Roman number 4. Sundry debtors. That will come on the sale value. What was the sale value that we had, friends? 520 lakhs into 8 divided by 52. How much will it come?
80 lakhs.
You get the answer as 80 lakhs. Okay. What is the next thing they are saying over here? Sundry creditors 4 weeks. So creditors is based on purchase. Purchase of only raw material will come over here. So how much is the raw material cost? 208 lakhs, correct? It will be 208 lakhs into 4 divided by 52. How much is that?
16 lakhs.
Again, that will be 16 lakhs. Okay. Anything else? Minimum cash 50. Okay. So from this, we need to find out the working capital requirement. So I'll write down the next working note. Working capital. Roman number 1 will be what? Current assets. Okay, so in the current assets, I'll write down point number A. What is going to be point number A in current assets? Raw material. So how much you got for raw material? 16 lakhs. Then you will have work in progress, 23 lakhs. Finished goods, 34 lakhs. Sundry debtors, I think you got the answer as 80 lakhs. How much is the cash balance they told? 50,000. So total will turn out to be 153.50 lakhs. This is your current assets. What is the second thing that you get over here? Current liability. Here you will have sundry creditors, that is 16 lakhs. So Roman number 3 will be your net working capital. 153.5 minus 16. That will give you the answer as 137.50 lakhs. We are done with this question also. Sandra, you have a very good point. Does selling overhead form a part of finished goods? Ideally, no. But if selling overhead is given as a part of production, then yes. Otherwise, no. If you ignore selling overhead, nothing wrong, Sandra. Good point. Are you all done writing this, friends? Can I go to the final part of cash budget? And with that, we can actually pack up today's session now. All right. All right. Let us start off now, friends. Cash budget, the final problem for today. Okay. Friends, this problem, why I'm not solving is because there's too much of routine calculations. For example, they want to prepare a cash forecast for 3 months. Okay. January sales is given, February sales is given, March sales is given. Agreed? Traders sells directly to public against cash and to other entities on credit. Credit sales are expected to be 4 times the value of direct sales. So for example, I'll just work out rough and show you. Particulars. You have January, February, March. We have the total sales. What is the total sales? 600, 600, 800. Correct? Now, they have told of this, credit sales is 4 times the value of this thing. So in this, if I break up into credit sales and cash sales, this will be 4, this will be 1, total will be 5. So what is 600 into 4 by 5? Can someone tell me what is 600 into 4 by 5? 120, 120 into 4. I think you'll get the number as 480. This one will be 120. Like that, you have to do all calculations. So if the last one, if you see, divided by 5 would be 160 into 4, 320, 640. And this one will be 160. All right. So after that, they have told he expects the customers 15% to pay in the same month, 25% in the next month, 58% in the next to the next month. So of this 480, how much is 15% of 480? Can you tell me? 48 and 24. I think that is 72 in this month. How much is the remaining they are telling over here? 25% in the next month. So that will be, I think, 120 in the next month. And another, how much percentage? 58% in the next to the next month. So like this, we have to do a lot of calculations, but they are actually very, very easy. After that, they told purchase of goods are made a month prior to the sales and it amounts to 90% of the sales. So if the sales is 600, how much is 90% of sales? 540. This purchase will be made in which month? December month. But they are making the payment in the next month. So this payment will go in which month? It will go in the month of January. Everybody clear? Then they have given you the cash balance and they have given you the actual sales for November and December also. Okay. And then they're asking you to prepare a cash budget. So let me take the solution now. Question number 29. Yes. So see, they have taken the opening balance, add sales. So sales, actually what they are adding is the collection part, not the actual sales. Okay. So they have taken the cash collection, they have taken the credit collection separately, and they have taken the total. All right. So then minus purchase, minus payment for purchase is done 540, 540, 720. Total closing balance. So whatever we did the adjustments, see, look at this, 15% in the same month, 25 next month, 58 next month. Cash and credit the same way how we did 128, 512, we did 600, 120, 480. This is what we did. They have done it for November, December also. Cash credit sales, receipts in this month, and the cash budget. Just read through this. If you have any doubts, let me know. Fine. This one problem, please work it out yourself. Because if I do it, we'll be simply wasting a lot of time. You doing it yourself will be making more sense. And this is a very, very easy question. All right, friends. So we are done with this question. And with this question, we have come to the end of this flash marathon. Friends, it took us 3 hours, correct? In the last 3 hours, we have covered majority chapters. Only 2 chapters I have left out. One is investment decision, and the other one is cost of capital theories I have left out, capital structure theories. That is, you have this net income approach, net operating income approach. So these are the 2 topics I have left out. Now the plan that I want to give you is tomorrow morning, once you wake up, early morning fresh, you do that topic which you find it difficult. So according to me, you can either go for capital budgeting or you can go for capital structure theory. Then remaining day, that is from 10 o'clock onwards till evening, you do all the chapters that we studied today. That way, full thing, today 1 revision, tomorrow you get 2nd revision. You become super strong in that. Last day of the exam, day after tomorrow is your exam. Early morning, if you're done capital budgeting tomorrow, do capital structure day after tomorrow. Okay, up to 10 o'clock. After 10 o'clock, don't do any more problems. You should not go to the examination hall with a fried mind. You should go there with a relaxed mind. If possible, take a power nap. Do only theory after 10 a.m. 10 a.m. to 1 a.m. only theory. Your brain should be absolutely relaxed. It should not be exhausted of doing problems. See, your brain is also a muscle. If you keep on running and then you go for a running race, you will never win that running race because your muscles are already exhausted and tired. So my request is last 2 or 3 hours, only do theory. When you enter the examination hall, your brain should be ready to crack problem. So the best thing you can do is around 10 o'clock or 11 o'clock, take a 15-20 minutes of power nap and see the magic. Because once you sleep, your concentration becomes 5x. Your answer solving ability will become more. Speed will increase, accuracy will increase. And ultimately, why are we studying so much? So that our speed increases, our accuracy increases, and we get more marks in the exam. Follow this plan and see, friends, exams will go very, very good for you. And any support you need, please WhatsApp me. I am always available on WhatsApp. My WhatsApp number is 8893495263. Okay. All the very best for your exams. I'm not taking much of your time. I hope this session was useful for all of you, friends. Thank you so much for your patient time. Study well. Have a lovely time ahead. Take care. Thank you. Thank you. Thank you, Sneha. Thank you, Mr. 23, and Maria, Sopna, Liana, Tirtha. Anjanadri, thanks to you too. Thanks a lot for helping me with the calculations. Thank you, Vaishnavi, Ashwin, Sania, Abdul Hafiz, Sriraj, Swati, Hari. Thanks a lot. Study well. All the very best. Do well. I am with you. Let's win together. Take care.